On behalf of Biz Talk Today TV and CrossCheck Media, welcome everyone to Buy, Hold, Sell. I am your trader, Todd Schoenberger, and I am joined by my friend and co-host, Tobin Smith, out in sunny and spectacular Scottsdale, Arizona. And you are moving, my friend, in Scottsdale, Arizona.
I am actually not moving. My wife is moving, and I'm just, I'm just filling up the car with gas, basically.
You're delegating. There you go.
I worked my ass off this weekend. I tell you, my iWatch thought either I was having a stroke or it said you've never you hit a new record for many stairs you've climbed. So I'm feeling pretty frisky.
You do look a little red today, my friend. So, but I'll tell you what, one guy who is hot, who is actually telling us that this market is just getting started with this rally, is Scott Ladner. He is the CIO at Horizon Investments in Charlotte, North Carolina. Scott, welcome back to Buy, Hold, Sell.
Hey, Todd, appreciate it, man.
Hey, Todd, and Scott, don't feel bad if you turn the sound down like 3/4, because sometimes I don't even use the microphone with Todd. I just.
Well, I got to say, Scott's got a lot going on in North Carolina these days. I mean, so many great projects that Horizon is involved with. But Scott, we were talking before the show started. I mean, you're still optimistic about this market. You had the Fed to cut a half a percentage point, 50 basis points, and you have the S&P hit another all-time high today. But you think this thing's just getting started. Am I right?
Yeah, look, yeah, you are. I mean, we still think, we've been saying this for a year and a half now. We still think the best analogy is the mid-90s. Like that is where we're sitting. This is the technology boom that can create the productivity boom. You only get them about once a generation if you're lucky, and this is it. And that's a pretty exciting place to be, frankly, in terms of markets. And then you throw on top of it just the adding fuel to the fire. The Fed, the Fed's now in a cutting cycle, so now we have the Fed put that is squarely back in place, and the strike is relatively close. And you have the consumer is in amazing shape, and you have companies earning money hand over fist, and inflation is done. So where is the big problems out there? We just don't see them.
Well, you should to go on to Goldman Sachs website and read their. I'm just reading it this morning. Their 24-page skepticism on generative AI, basically in a nutshell, saying where are the applications? I mean, I understand we're building 125 new data centers, and that means we're going to have probably 450 gigawatts of power per state to make that all happen. But how do you answer that? Because I mean, frankly, I love my ChatGPT 01 now. I use it for just about everything. But where's the business model in that? It's $7 a month.
Look, there's going to be some learning curve as companies try to figure out how to use this stuff. But there's a learning curve with the internet too, if we all remember. Like, people were throwing the websites that made no damn sense. Like, there's all sorts of fraudy things that happened in the midst of that. We're going to get some of that here too. But the most important thing that actually I thought coming out of the that NVIDIA earnings call, I don't care about Blackwell. I don't really know anything about NVIDIA, the company, period. I'm just not that bright. But what I did like to hear, though, I did like to hear what they were saying about the different types of companies that were coming in and requesting these chips. And it's like everyone from industrials to healthcare folks. Biotech's an obvious one, but and just kind of like companies across the board in terms of the economic spectrum in the U.S. Like, everybody's looking to try to figure this out. And I basically just believe in American ingenuity that they will. There will be winners and losers out of this thing, and picking those in the next probably the next 2 or 3 years. This might be one of the most important jobs of investment managers.
I would agree. I will say that it's interesting that finally, when the utilities were leading the market, I was scratching my head a little bit, but no, it makes perfectly good sense because of the amount of power you have to generate. Then we're long some of these small module reactors, SMR, and a couple other ones, and it was great to see Microsoft sign a deal with 3 Mile Island yesterday. To relaunch or reactivate that the other nuclear plant they have on the premises, because we're not going to get there. We've done a lot of math on the electricity part, and we're not going to get there if we don't have these small nuclear reactors. And
100% agree with you. Like that like they're every revolution needs some sort of a spark to get it going, and getting alternative energy and specifically nuclear energy going in this country might be one of the best things that ends up happening if we look back 50 years from now. And AI might be that spark to get it going.
that's a good point.
That is a very good point. Scott, with the Fed rate cut, and you said there's not a lot out there. I mean, you don't have those cautionary flags out there, but what would justify the Fed cutting 50 basis points?
I think actually, Todd, it was a risk management move by them. It was pretty clear. Powell's speech, I think, in Jackson Hole, I think surprised everybody.
Yeah,
and really surprised people in the Fed if you kind of read between the lines.
Right.
And so he had a job to do. He had a communication and pulling people along job to do, because he's definitely sees weakness in the labor market. We do too. The labor market is weaker than it was, a couple of years ago, and that's not a bad thing. but it's definitely weaker. And so he just views that, the balance of risk essentially more on the labor market side. So he wants to go ahead and try to get ahead of this curve a little bit. He wants to be known, and everybody's got ego.
Yeah.
He wants to be known as somebody that this nails the soft land, nail the inflation thing, or eventually, and nails the soft landing part. It's really hard to do. There are only a few instances of history when we've done it. And I think he just thinks that, look, we've got some room to go. Everybody thinks they need to get to about 3% over the next 12 to 18 months. And if you're going to do that, it's hard to do that to go in 25s. Let's just go ahead and get there.
Yeah. We have the new R word, right? We were all worried about recession. Now we have recalibration.
Yeah, right.
And it was interesting yet to see him sort of basically look everybody in the eye and says, read my lips. We're getting to 3%. And that what they're most worried about, inflation, genie's back in the bottle. But it is unemployment rates. And, let's not kid ourselves that the bottom 50% of households in the United States work mostly on hourly wages. And they're sort of, treading water. And it's, as Todd, I say every week, it's the top 25% of households that are doing 72 to 73% of discretionary. And that's, to me, always been the number I look for on expansion or contraction, because when the discretionary spending comes down, then that hits services, that hits goods, that hits all sides of the economy.
Yeah, you're right about that. So Scott, you mentioned technology. Are there any other sectors that you and Horizon are optimistic about for the rest of the year?
We actually have utilities on and off. It's a little bit scary here.
Pardon the pun.
So it's interesting. We actually we have a marketing piece that we put out, or a thought piece we put out every week called the Big Number. And the big number that's getting put out today is actually it's 28% or 28. And that is what utilities are up year to date. If you ask somebody what sector is leading the market this year in 2024, not a darn soul is going to tell you it's going to be it's utilities. Everybody can say tech or communications or something like that. It's not. It's utilities are leading the market right now. So it's it's a little bit scary to get in here, but we still generally like them. The other ones would be the home builders we do like. It's the most direct play on a sort of a rate cycle coming down. If we do get a refinancing boom, which I think we will get a refinancing boom once mortgage rates normalize to about 1% over 10 years, they're about 1% too high right now relative to where they should be. So that we could actually get a little bit of refi boom or a little bit of juice there. So we do like some home builders. We do like the biotechs of the world, especially on the AI front. But it's really tough to pick the winners in that one. So we're just kind of going broad on the biotech front. And more broadly, if you can't play the biotechs, you can just play into healthcare. We think those are going to be big winners out of this. And then lastly, we actually like energy still. It is the cyclical that has the least exposure to China, which is a disaster. Still a disaster. Will be a disaster probably for a while. And it's got some geopolitical hedge characteristics. If something really does happen over the Middle East, you get there's a little bit of safety there. And we do think this market is going to start to broaden out here in the fourth quarter. And energy could actually sort of help play along with that theme as well.
Well, how about natural gas versus oil? I mean, I'm actually short oil and long natural gas. Now today I'm a genius. It's up 8%. What? I missed something. I've been moving. Was it just the hot weather again for natural gas that prompted? I'm definitely not the right guy to ask about natural gas versus oil spreads. It's like ours is probably more of a general play. We're not sort of in the weeds enough. I would call us tourist money in that space. So I'm not in the weeds enough to really give you a smart opinion about that. No worries. Thanks. Your boss asked me to ask that question for you. So
Your wife, my wife asked you. I didn't know. It's weird.
I'll be here all week.
I didn't know she had your number.
Don't forget to tip your waiters and waitresses.
There you go. There you go. Yeah. Well, guys, let's leave it on this block, because coming up next on the next block, we're going to start quizzing Scott about earnings season, which kicks off in a couple of weeks. And also, there's this thing, this election I've been reading about coming up. Maybe there's some sectors that you might want to stay away from depending on which candidate wins. But we'll get into all of that in the next block. But with us today is Scott Ladner. He is the CIO at Horizon Investments in Charlotte, North Carolina. And we'll be right back after the break. Please stay with us.
Buy, hold, sell, brought to you by CrossCheck Management.
You make me sparkle, you make me tingle, even the stars are brighter when I'm with you. And when I surrender to a tasty kiss or two,
Martini and Rossi iced tea.
You make me sparkle, yes,
make the moment sparkle.
Welcome back to Buy, Hold, Sell. Well, with us today is Scott Ladner. He is the CIO at Horizon Investments in Charlotte, North Carolina. And we left off at the last break. We were talking about how certain sectors, obviously tech, is going to remain strong for the rest of the year.
Hey kids, I'm doing TV here. Thanks.
But I love the live TV. This is awesome. But we want to ask Scott, with earnings season coming up, and now S&P forecasts are projecting still a decent earnings period for the third quarter, and we should be getting some results in the next couple of weeks. But what do you think, Scott? I mean, is there anything out there, any type of headwinds that might be a cautionary tale for investors as we go into earnings period?
Well, look, I mean, I think people are concerned a little bit about the consumer starting to act like they answer surveys. Like personally, I don't think that's going to happen. But if there's a risk out there, I see, that's one or two that I see that could be. People have been answering surveys for the last year and a half. Like their feelings are in the toilet. I mean, like they answer surveys like it's 2008. If you ask them about their personal finances or how the economy is doing or things like this, those answers are just awful. I mean, people do not feel good about the world right now. But that stands in stark contrast to the objective reality of how their personal, how their situation actually is. Household leverage and debt service are lowest levels in 40 years. We just went through basically a decade of deleveraging from the financial crisis until COVID. So people's balance sheets are in great shape. Everybody's getting raises above inflation. So people are generally in good shape, but they answer surveys like they're not. And so one thing we've been just watching is to say, listen, if people start actually behaving like they feel, economically, that could definitely provide a tailwind, or a headwind towards earnings and growth. But you guys talked about earlier that retail sales coming out is still strong. So retail sales we don't usually look at that much. We've been watching like a hawk for the last 6 months because I've been worried that the consumer is going to start to pull back and start to act like they feel. But we haven't seen it. We haven't seen the consumer pulling back. They haven't been changing their spending patterns. We're actually back to pre-COVID spending patterns in terms of, are we spending more? What are you spending money on, like goods versus services? Pre-COVID is basically 2/3 on services and 1/3 on goods, and then basically flip-flop during a lot of COVID, and we're back to that kind of normal relationship again. So everything's sort of normalizing on that front. So that on that side, consumer behavior and consumer spending patterns is one thing we'll be watching. I don't think it'll be a headwind, but it's something you got to be aware of.
Well, you can throw into your calculus again the fact that the bottom 50% own 3% of all stocks in the country, so they're not worried about that. The bottom 50% is the group that gasoline prices was hurting, and then of course grocery prices because blah 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 blah, because it hurts them. The top 50% are not bitching and moaning, except for the fact that they didn't get to buy a house in 2019, and now their next door neighbor's house is worth $2 million, and they're sitting there pissed off. But in reality, we're strong. The one I would say though is post-Fed cuts, the market traditionally almost always has been higher. And from the day of the cut, 6 months out, 8 to 10 months, 8 to 10% has been the average. In this situation, if I get to refinance my 9% mortgage and get it down at 6 in those households that own 75% of the houses, man, that spending at the margin or on the margin really starts to kick in. And now you start to say, yeah, maybe we'll go to a UCLA game and spend $5,000 to fly down there, and or University of Texas, or someplace that you'll travel and you'll spend the money because you have excess cash flow. The problem with the bottom 50% is they spend every dime they get, and they have no excess cash flow. And then when inflation went up 6-7%, they didn't get any more 6 to 7% out of their salaries or out of their retirements. And then we got 5,000 people turning 65 or 70 every day till 2032. Those people are happy as hell. So that's, in my estimation, that's why I'm not worried about a recession, because all the engines of recession are not going backwards; they're going positive.
Right. No, that makes sense. And by the way, nobody's going to spend $5,000 to go see UCLA lose. By the way, I just want to throw that out there.
That is hurtful. That's right here, man. Right here.
There you go. So let's switch gears on this for a moment here. So Scott, you got the election coming up. We're what, 5 weeks away. Are there any specific areas that investors can maybe focus on if one candidate wins, or maybe they should stay away from? I mean, you're probably fielding a lot of calls from your own clients about this. I'm just curious what you were telling them.
Yeah, look, we're telling them to basically try to close their eyes and ignore it, at least from a financial standpoint. Because every single time you try to trade based on your politics, you lose. So if you thought Reagan was an idiot and you didn't invest, you lost. If you thought Clinton was a planter and you didn't want to invest, you lost. If you thought Bush 1 or Bush 2 or any of the Bushes were bad guys and you didn't invest, you lost. If you thought Trump was the Antichrist and you didn't invest, you lost. If you thought Biden was brain dead and you didn't invest, you lost. So like every time you try to, if you try to trade based on your politics, however they may be, you're going against America. And you're going to be wrong, because it's a pretty darn good country with pretty darn good companies.
But we always say that it's not the president. It's what happens if they sweep. What happens if the Republicans sweep or the Democrats sweep? Now, I think beyond the IQ test that people should have to take to vote, I think they should actually also understand the concept that the president is only one of the 3 parts of our political system. And no matter what president gets elected, unless they have a sweep of the House and the Senate, they're going to get a few things done, and it's not going to change your world.
Yeah, Tobin, I think actually that's an excellent point. Like the only scenario under which we think there's potential for some market stress is in that sweep event. I don't think that's very likely right now, but who the heck knows? It's 5 weeks. It's going to feel like 5 years. And so it just is what it is. But if we do get that sweep, we'll have some conversations we have to have. But that that definitely looks like the outlier. But who the heck knows? We'll see.
Yeah, one of our recent guests, Jay Hadfield, God bless him. He's just saying, dude, if we get 15% corporate tax rate, do you understand that the EPS is going to add to the earnings? And the answer is, I'll believe it when I see it. But yeah, it would. The stock market would like that. There's no question about that.
Right. Well, that remains to be seen. But yeah, there's a lot of things. I mean, we're hearing it from both angles, and you are right there, Scott. I mean, if you think about it, had you been thinking, okay, I'm going to be bearish, you definitely lost out. So you have to think that a Harris administration might be continuing with a lot of those policies. Therefore, you might actually see a continued rising market. But it really depends. I mean, and like you said, just it's best thing just to stay away from it and just keep moving along.
So. Well, here's an example. They start the Green Deal, right? And there's $5 billion or $15 billion allocated for this stuff, but people are borrowing money to build a solar plant or borrowing money to build a windmill. Although I think the windmill thing's finally dead. But what's going to affect it is interest rates that the Fed runs. And that's what I think just people have lost their minds about, to think that, yeah, they got a $15 billion, IRA, Inflation Reduction Act, still the funniest, term for greenwashing I've ever seen. But it didn't do anything. Matter of fact, you look at those stocks. We recently bought First Solar, but solar, wind, everything else has been in the tank because of interest rates, not because of the IRA plan. So I'll shut up now. Those are people going behind me are moving things. I've hired women to be the movers, just because I could.
Oh my goodness, let the emails flow in. So we'll see what happens. All right, so guys, we're going to leave it there. So Scott, thank you once again for joining us on Buy, Hold, Sell. You're a fabulous guest. Can't wait to have you back again. Definitely.
And when does the ETF come out?
Oh yeah.
Yeah, so we will be launching some active ETFs here in the coming months. Probably early next year will be the first ones when that'll come out. But we're excited.
All right, well, let us know, because then you'll be able to talk about them. Damn it.
That's right.
Yeah, we'll definitely have you back then, and we'll want to promote those. And I know the audience will be interested in hearing a little bit more about them as well. So that's a definite. So Scott, thanks again for joining us on Buy, Hold, Sell, and can't wait to have you back when those ETFs come out. And it should be great for all of us.
As long as you beat the index funds, you're invited back. Okay.
Deal.
Absolutely, absolutely. So coming up later in the week on Thursday, we have Eric Johnston from Cantor Fitzgerald will be on Buy, Hold, Sell. On Janet Alvarez's show, The Money Pass, she is Ryan Dietrich is the featured guest. So lots to look forward to for the remaining for the last full week of September, and obviously the last full week of the third quarter. So much to get to. So on behalf of Scott Ladner and Tobin Smith, I am Todd Schoenberger. Thank you once again for joining us on Buy, Hold, Sell. We'll catch you next time. Take care.
Buy, Hold, Sell, brought to you by CrossCheck Management.